Welcome to the Radio Revenue Podcast. Today, we're diving deep into a really fascinating piece of legislation, one that could seriously reshape the world of digital assets. We're talking specifically about payment stablecoins in the U.S.
Wow, yeah, we're looking at Senate Bill 1582. The official name is the Guiding and Establishing National Innovation for U.S. Stablecoins Act. Bit of a mouthful. Most people are calling it the Genius Act, which is, well, catchier. Lawmakers started work on this back on January 3rd, 2025, and the whole point is to provide a clear regulatory framework, something that's been needed for these digital currencies. You've probably heard tons about stablecoins, right? They're supposed to hold a stable value, usually pegged to something like the US dollar. But this deep dive, our mission today, is really to give you a clear, concise understanding of what this proposed act actually means, who it impacts, why it's such a big deal for, well, the whole financial system. We want to cut through that dense legal stuff and pull out the key insights for you.
Exactly. And what's so interesting here, I think, is that it's not just, a dry technical document. It's really a foundational attempt, trying to bring some structure, some stability to this space that's often felt a bit like the Wild West of digital finance. So we'll be breaking down the core definitions, looking at the pretty strict requirements for anyone wanting to issue these stablecoins, and thinking about the broader implications, for the financial system, but also for individual users like you.
Precisely. It's a blueprint, really, for how digital money might work going forward. So grab your coffee, settle in, because we're about to unpack some seriously impactful stuff here.
Yeah.
Okay, let's start right at the beginning then. The Genius Act focuses specifically on payment stablecoins. So, just to make sure we're all on the same page, what is a payment stablecoin according to this bill? And maybe just as key, what is it not?
Right. So the Act defines it as a digital asset, and its main purpose, its design, is for use as a means of payment or for settling transactions. The absolute key part is this. The issuer is legally obligated. They have to convert or redeem it for a fixed amount of monetary value, and they have to represent that it will maintain a stable value relative to that fixed amount, or at least create a reasonable expectation it will. Think of it like a digital token that's always supposed to be worth, say, exactly $1.
A digital IOU, kind of?
Kind of, yeah. And what it isn't is also really important for how it gets regulated. The definition specifically rules out a few things. It's not a national currency, obviously. It's also not considered a traditional bank deposit, even if the records are kept on, like a blockchain. And here's a really big one. Section 17 of the Act makes it clear. A payment stablecoin issued by a permitted issuer is not treated as a security or a commodity under those old laws, like the Securities Act of 1933 or the Commodity Exchange Act.
Okay, hold on. Let's unpack that bit. Why is that so significant? Saying they're explicitly not securities or commodities. What does that actually mean for how they'll be regulated or how, we might end up using them?
Well, it's a critical distinction, really. By carving them out like this, the Act is basically forging a whole new regulatory path just for them. It's trying to avoid all the complexities and maybe even conflicts you'd get trying to shoehorn stablecoins into rules originally designed for, say, stocks or oil futures. It means a different set of rules will apply. Rules focus specifically on their job as a payment method, not as an investment you hope goes up in value. This could actually make it easier for them to be adopted for, everyday transactions.
Ah, okay. That makes sense. A tailor-made framework. So who actually gets the green light to issue these payment stablecoins in the U.S. under this bill? Because the Act says only permitted payment stablecoin issuers can do it. Who's on that list?
Right. It's an exclusive club. The Act outlines 3 main ways to become a permitted issuer. It's kind of inviting different players into the regulated space. First, you've got subsidiaries of insured depository institutions. So think traditional banks or credit unions setting up a specific approved branch or entity just for issuing stablecoins.
Okay, the banks are in.
Yep. Second, there are federal qualified payment stablecoin issuers. This is a bit broader. It includes non-bank companies approved by the controller of the currency, special uninsured national banks also chartered by the controller, and federal branches approved by them too.
And non-banks can get in too, but under federal oversight.
Exactly. And third, you have state qualified payment stablecoin issuers. These are companies set up under state laws, and they need approval from a specific state payment stablecoin regulator.
Okay, so federal and state paths. But it's clear not just anyone can whip up a stablecoin in their basement. What happens if someone tries to issue one, but they're not on this permitted list? Does the law actually have teeth?
Oh, absolutely. It's spelled out. It's unlawful. And the penalties are quite substantial. We're talking fines up to $1 million per violation. plus up to 5 years in prison, or potentially both.
Wow. Okay.
And beyond that, stablecoins issued by these non-permitted outfits, they won't be treated as cash for accounting, they won't be eligible as margin or collateral for banks and other financial firms, and they won't be usable for those big wholesale payments between banks.
So it really pushes everyone towards the regulated path.
That's the idea. It's a serious deterrent.
Got it. What about stablecoins coming from outside the U.S.? How does the act handle foreign issuers?
Generally, foreign payment stablecoin issuers are prohibited from offering or selling them here in the U.S. The exception is if they can show they have the tech to comply with lawful U.S. orders and if there are reciprocal agreements set up by the Treasury Secretary. There are some very narrow exceptions, like for really tiny, insignificant transactions, they call them de minimis, or in very specific, unusual and exigent circumstances. But the Treasury Secretary decides that. It really puts the focus on U.S. control and oversight.
Right, keeping it within the U.S. regulatory perimeter. Okay, so for those who are allowed to issue, the Act lays down some incredibly strict requirements, all designed presumably to build trust and ensure stability. What are the sort of core pillars here? What makes a stablecoin actually stable and trustworthy under this law?
Yeah, this is really where the bill tries to tackle those past worries about whether stablecoins might, break the buck. Section 4 lays out several critical requirements. Pillars, as we call them. First, and probably the most crucial, is one-to-one reserve maintenance. Permitted issuers must hold identifiable reserves backing every single stablecoin they've issued on at least a one-to-one basis.
Meaning $1 in reserve for every $1 stablecoin out there.
Precisely. And the types of reserves are very specific. They have to be super safe, super liquid assets. We're talking U.S. coins and currency, funds held at the Federal Reserve, demand deposits at insured banks, short-term treasury bills, notes or bonds, specifically 93 days or less maturity, certain types of repurchase agreements, and registered government money market funds. Even tokenized versions of these assets are allowed, interestingly.
So no risky corporate bonds or, other digital assets backing these things. They want it to be as solid and, frankly, boring as possible.
That's exactly the aim, reliability. And adding to that, there's a strict prohibition on rehypothecation.
Rehi what?
Rehypothecation. It's a fancy finance term. Basically, it means the issuer generally cannot reuse, lend out, or pledge those reserve assets for anything else. There are very narrow exceptions, like for specific margin needs or creating liquidity just to meet redemption requests, but the general rule is hands off the reserves. It's about keeping that clean one-to-one link crystal clear. Those reserves need to be there, ready, if people want their money back.
Okay, that makes it truly backed, not just theoretically backed like some bank deposits might be handled. What else is key?
Next up is transparency. There's a strong requirement for public disclosure and redemption policy. Issuers have to publicly post very clearly how users can redeem their stablecoins back into regular currency and list any associated fees, no hidden costs. They also have to publish monthly reports right on their website. These reports have to detail the total number of stablecoins outstanding and the exact amount and composition of their reserves, even things like the average maturity of the assets and where they're physically held.
Full transparency so anyone can check.
Exactly. And to make sure those reports aren't just, made up, there's monthly certification and audits. The information in those monthly reports, it has to be examined by a registered public accounting firm, like a proper audit. Plus, the CEO and the CFO of the company have to personally sign off, certify the accuracy of these reports every single month. And if they make false certifications, there are criminal penalties. That puts real personal accountability on the line.
Wow, okay. That's serious oversight.
Yes.
I feel like they're trying to build trust through proof, not just promises.
That's definitely the impression. The bill also mandates specific capital, liquidity, and risk management requirements tailored to these issuers. Regulators will set standards for things like how diversified the reserve assets must be, how they manage interest rate risk on those assets, and their operational risks, think cybersecurity, compliance systems, IT infrastructure. And crucially, this explicitly includes making sure they comply with the Bank Secrecy Act and all the sanctions rules, basically applying the same kind of rigorous financial crime checks you see in traditional banking.
Right, integrating them fully into the anti-money laundering framework. What about earning interest? I know some digital assets offer yield. Can you earn interest just by holding these stablecoins?
That's a great question, and the Act is very clear on this. No interest payments. Permitted issuers, and even those foreign ones allowed under exceptions, cannot pay any interest or yield, whether that's in cash, more tokens, whatever, just for holding or using the stablecoin. This really reinforces the idea that these are meant to be payment tools, like digital cash, not interest-bearing accounts or investments.
Okay, so no yield farming directly from the issuer. What else?
Then there are rules aimed at fair competition. No tying. An issuer can't force a customer to buy another product from them or an affiliate just to get stablecoin services, and they can't make you agree not to use a competitor's service either.
Standard anti-tying stuff, like
Yeah.
in banking.
Pretty much. Also, no deceptive names. Issuers can't use names like United States stablecoin or USG coin or anything that makes it sound like it's official legal tender issued by the U.S. government or backed by a government guarantee. They can use USD in the name if it's actually pegged to the U.S. dollar, but no misleading marketing about government backing.
Makes sense. Got to manage expectations.
Absolutely. And for the really big players, issuers with over $50 billion in outstanding stablecoins, there's a requirement for annual fully audited financial statements, prepared by a registered public accounting firm, made public, and submitted to the regulators. Even more transparency for the systemically important ones.
Okay, that's a hefty list.
One more interesting point. Non-financial public companies. Think about a big tech company, maybe, that isn't primarily a financial firm but wants to issue a stablecoin. They face an extra hurdle. They need unanimous approval from a brand new committee, the Stablecoin Certification Review Committee. This committee has to be convinced the company issuing the coin poses no material risk to the financial system. And crucially, that company has to agree to strict limits on how they use customer data obtained through the stablecoin service. No targeted ads, no selling the data, no sharing it with non-affiliates without explicit consent unless it's for legal compliance.
So trying to prevent big tech from becoming unregulated banks and leveraging the payment data in ways traditional banks can't.
That seems to be the goal, yes, creating guardrails.
That is an incredible amount of detail. It really does sound like the bill is trying to create a very robust, very transparent, and hopefully secure environment for stablecoins.
Exactly. It's about bringing them into the fold, integrating them into the existing financial structure with appropriate oversight, not letting them exist in some parallel, unmonitored universe.
Okay, so we've talked about who can issue and the rules they have to follow. What about the regulators themselves? How does this dual federal and state path actually work?
Right. The Act sets up this two-track system. Your federally qualified issuers and those subsidiaries of existing banks. They fall under the main federal financial regulators, the Controller of the Currency, OCC, the FDIC, the Federal Reserve, the National Credit Union Administration, NCUA. These federal agencies will handle everything. Licensing, ongoing regulation, examinations, supervision, the whole 9 yards.
Standard federal oversight. What about the state-chartered ones?
For the state-qualified issuers, they get the option to be regulated primarily at the state level. But, and this is key, only if that state's regulatory framework is judged to be substantially similar to the federal one outlined in the Genius Act. The Secretary of the Treasury is tasked with setting out the principles for what substantially similar actually means. So, states need to meet a certain bar.
Okay, so states can regulate, but they have to meet federal standards. What happens if one of these state-chartered issuers gets really big, like systemically important? Does the federal government step in then?
Yes, there's a specific trigger for that. If a state-qualified issuer's total outstanding stablecoins grow to exceed $10 billion consolidated across its operations, they have 360 days to transition into a system of joint federal and state regulatory oversight. Or they have to stop issuing any new stablecoins.
So once they hit a certain scale, federal oversight becomes mandatory, even if they started under state rules.
Exactly. Waivers are technically possible, but only under very strict conditions, like if the state already has an incredibly robust system and the issuer isn't deemed a major risk to the whole financial system. It's clearly designed to bring the big players under federal scrutiny.
That's a really interesting tiered approach. Collaborative, but with federal backstops. Now, beyond just who regulates, how does the bill try to make sure all these different stablecoins, maybe running on different blockchains, can actually work together? Is there anything about interoperability?
Yes, definitely. That's addressed in Section 12. It mandates that the primary federal regulators working with NIST, the tech standards body, and others have to assess the need for and potentially prescribe standards for interoperability. The whole point is to promote compatibility, between different permitted stablecoin issuers, but also with the wider digital finance world, including different blockchain platforms. They want to avoid creating a bunch of siloed systems that can't talk to each other. The goal is a more cohesive market.
So stablecoins could potentially move more easily between different apps or platforms.
That's the hope. And this focus on tech standards also connects to another important area: anti-money laundering. AML innovation. The act requires the Treasury Department to go out and seek public comment on new innovative ways. Things like using AI, specialized APIs, advanced blockchain monitoring tools to spot illicit financial activity involving digital assets more effectively.
Using tech to fight tech-enabled crime.
Precisely. The feedback and research gathered will then inform future guidance and rules from FinCEN, the Financial Crimes Enforcement Network. This includes potentially developing standards for how to monitor transactions involving mixing services. Those tools sometimes used to obscure crypto transaction trails, all aimed at making it harder for criminals to use digital assets for illicit purposes.
So it's not just regulating the issuers, but also trying to upgrade the tools used to police the whole digital asset space. That's quite forward-looking. Okay, moving beyond issuance and day-to-day regulation, how does this act protect users, us? Especially if something goes wrong, like an issuer gets into financial trouble. Is our money safe?
That's obviously a huge concern, and the Act has some pretty strong provisions on custody and what happens in an insolvency scenario. First, only regulated entities are allowed to provide custody services for the stablecoin reserves or the private keys needed to control them. Can't just have anyone holding the backup assets. And these regulated custodians have a legal duty to treat the customer's assets, the reserves backing the stablecoins, as belonging to the customer. They have to be segregated, kept separate from the custodian's own assets. And here's a really critical part. In case the custodian goes bankrupt, the claims of the stablecoin issuer on behalf of the holders against that custodian get priority. They jump to the front of the line ahead of the custodian's other creditors, specifically for those segregated reserve assets.
Okay, so protection if the custodian fails. What about if the stablecoin issuer itself goes bankrupt?
That's where it gets even more interesting, and frankly, quite powerful for users. The Act actually goes in and amends the U.S. Bankruptcy Code Title 11. It explicitly grants priority to the claims of stablecoin holders in the event the issuer becomes insolvent, specifically their claims against the pool of required stablecoin reserves.
Wait, so stablecoin holders would effectively be first in line to get their money back from the reserves if the issuer fails.
That's the intent. It's a significant step to ensure that holders have the best possible chance of being made whole, or at least getting preferential treatment compared to the issuer's other general creditors. It elevates their claims specifically against those mandated reserves.
Wow. That is a huge aha moment, like you said earlier. That feels like a critical layer of consumer protection, something that's often missing or unclear in the current crypto space.
Absolutely. It's designed to build significant user confidence. But it's also crucial to understand the limits. The Act explicitly states and makes it unlawful to misrepresent this, that these payment stablecoins are not backed by the full faith and credit of the United States government. They are also not covered by federal deposit insurance, like your regular bank account might be.
So priority access to reserves in bankruptcy, yes. Government bailout or FDIC insurance, no.
Exactly. The lines are drawn clearly. Issuers face significant penalties if they mislead people about government backing. It ensures consumers understand the specific protections they do have and what they don't.
Okay, so as we kind of wrap up this deep dive into the Genius Act, it's really clear this is a massive, comprehensive effort, trying to bring clarity, trying to bring stability, and adding some really crucial safeguards to this whole world of payment stablecoins. We've covered a lot from the definitions, those strict reserve rules, the AML innovations, right through to these explicit bankruptcy protections. It really feels like they're trying to build a robust, predictable framework.
I think that's right. This deep dive really shows a very deliberate, methodical effort, trying to integrate these digital assets, stablecoins in particular, into the existing financial system, giving them proper oversight, but also recognizing, what makes them unique. That emphasis on transparency, on financial soundness, and definitely on consumer protection, it runs throughout the entire bill. It really marks a significant step towards maybe the mainstream adoption of regulated digital money.
It absolutely paints a detailed picture of what the future of stablecoin regulation could look like. Hopefully you listening now have a much more solid foundation for understanding the kind of legal and operational landscape this act is trying to create.
And if you think about the bigger picture here, this act really signals a kind of maturation, doesn't it, for the digital asset space, moving from, pure raw innovation towards becoming a more regulated financial instrument. It reflects just how important stablecoins are becoming in the global economy. It's laying down a foundation, really, for what comes next in digital finance.
Yeah, building those guardrails. And that brings us nicely to our final provocative thought for you to mull over. Given how incredibly comprehensive this act is, focusing so tightly on payment stablecoins, what do you think will be the next major area of digital assets
to get this kind of detailed legislative attention? Will it be DeFi, NFTs, something else entirely? And maybe more broadly, how might this act, the Genius Act, pave the way for future innovation and regulation across the entire digital finance ecosystem? Something to think about. It was a Revenue Radio podcast. Thank you for watching. Please like, subscribe, and hit the bell to stay updated with our latest analyses.